Hello and welcome to Morgan's post-reporting season high conviction update. I'm Andrew Tang, I'm an equity strategist. First of all, I'd just like to touch on reporting season. We've got a detailed note out that came out on Tuesday, so speak to your advisor if you want more details or if you want a copy of that note. I'll just touch on three very high-level points about reporting season. Firstly, the good. Finally, we did see the end of the earnings recession. Earnings came in at 6.3%, and earnings is expected to tick up to between 7 and 8% over the course of FY18 and FY19, which is encouraging, particularly after 2 years of earnings decline. Secondly, it's consistent with the CapEx survey, which was released last week, which saw an improvement. There are some signs that ASX-listed corporates are again beginning to invest in their companies. For instance, we saw AMP, Suncorp, as well as CSL reinvest in the future. So despite not being rewarded on the day, we certainly think it's encouraging that corporates are once again looking at growth CapEx and reinvesting in their businesses. So finally, perhaps some of that business confidence that we saw leading into reporting season is finally translating into outlooks and investment plans in FY18 and FY19. So certainly a good sign there. However, the bad, what we did see under our coverage universe was the misses outnumbering the beats, a reverse of what we've been seeing over the last few reporting seasons, which is somewhat not so encouraging. We also did see the outlook commentary. We hope for better outlook commentary leading into this reporting season, given the business surveys, as I alluded to earlier. But corporates are still pointing to the weaker consumer, pointing to just a lack of demand and focusing again on cost cutting as a means to shore up the business. And finally, the more ugly side of the market had to be the large cap. You didn't have to look too far to find a large cap underwhelming the market. So Telstra, Woolworths, QBE, James Hardie, there are a number of large caps which really disappointed the market. And what we did see at this point in the reporting season was that rotation back into the small caps. Whilst small caps typically had higher amounts of earnings downgrades post their results, the actual price reaction was positive. So that really suggests that potentially some of that negative earnings pressure into results was already reflected in the price, and perhaps some of that large cap disappointment. On top of that, we had CBA and their compliance issues, certainly weighing down on the large cap and seeing this rotation back into the small cap side of the economy. And if you look at what happened during reporting season, we did see the utilities, the infrastructure stocks, as well as resources, obviously outperforming. So they're really that chase for yield, chase for growth, thematic really continue to play out. So we do think from here, small caps may continue to find a bit of support given the weak outlook in some of these large cap names. So this month we've added 3 new stocks to our high conviction list. We've got Aventus, PWR, and NextDC. I won't go through the details today, but I'll refer you to the videos of our analysts discussing all of these stocks and the 3 buy points and why we like it. So despite the economic headwinds that are coming in the macro economy, we certainly see these 3 companies, which provided really good results in August, as being 3 very strong plays despite what is a subdued economic environment. So please click below for more information about the 3 stocks. Thank you very much.